Welcome back to the show. Today, again, we have an incredible guest. We're joined today by Bernadette, and she is an account representative of CMHC. This should be an interesting episode for anybody who's ever bought real estate or who's thinking about buying real estate and wondered about what is that whole 5%, 20% down insurance? Like, what does it actually mean? Now, she breaks that all down for you guys and explains some of the programs that a lot of people don't know about to save you some bucks. As always, myself, Alex McFadden, my partner, Derek Williamson today, and not in the episode is Dean Lawton, are part of Thrive Mortgage Co. And our team is here to take care of your financing, make sure that you provide the best financial solutions to create wealth in real estate. That is our mission. If you guys are loving the show, make sure to leave us a 5-star review on iTunes. That helps us keep going. That's the gas that goes in our engine. And if you do so, we'll provide you with a incredibly beautiful, sexy little Thrive mug with some coffee. It's delicious coffee from a local roaster down here. Anyways, that's enough for me. I hope you guys enjoy the show. Make sure to share it if you like it or let us know. Talk to you soon. What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. All right, guys, we are here today joined by Bernadette. Bernadette actually, in her spare time, plays a piano. That's her superpower. Apparently very good. So good to the point that she plays it in front of people who love to eat fancy steak. This is coming from a vegan, by the way. Bernadette actually joins us. She's with CMHC. I believe her official title is now Account Manager.
Representative.
Account Representative.
Don't get it twisted.
Okay, I'm not going to get into it. Account representative from CMHC, and who better to bring on the episode than an individual who is right in the thick of the know as far as CMHC. You know, Bernadette, we've had so many people come on, that we speak to as far as clients recently that just ask so many questions around what is CMHC, how does it work? I mean, we get these questions all the time, but you know, we just figured it would be best to have someone like yourself come on and really just help set the record straight.
Sure.
So thank you for joining us. Before I even get into that, I got a long intro here. Before I even get into any of that, tell us first and foremost, with what's happened recently and what's been going on with this quote unquote second wave, how has your day-to-day changed and been affected in the last 6 months?
I mean, I think I'm in the same boat as kind of everybody else. And, you know, as a corporation, like as at CMHC, we've actually been quite lucky in terms of transitioning to a pretty virtual environment prior to COVID. So the transition for us, I think, as a corporation has actually been quite smooth. So we were really fortunate because most of us had already kind of been working from home, utilizing virtual platforms, upgrading our technology to be able to do all of that. And so, like I said, it was not seamless, but probably a smoother process than some other larger organizations. For myself personally, I really miss seeing clients in person. I wish I could, be there doing the podcast with you guys in person. It would probably make the technology stuff a little bit easier, but here we are, and still pretty lucky to be able to touch base with everyone and connect with everybody using technology. So it's been definitely a bit of a change, but I miss seeing people and the in-person interaction for sure.
That's awesome. So you actually referenced clients. So I was curious, maybe you can kind of fill us in on who your clients are. A lot of people think consumer, right? I think your clientele is a little bit different.
Yeah, so personally, my job or my role as the account representative for the BC region is to work with mortgage professionals, so banks, lenders, brokers, and provide the training, education, and support around really anything CMHC related, but our biggest focus with you guys as my clients or partners is, of course, around default mortgage loan insurance, which we will get into a little bit later. But there's a number of things, obviously, that CMHC does. For those listening who maybe don't even know what CMHC stands for, it's Canada Mortgage and Housing Corporation. And essentially, we're Canada's national housing agency and the #1 provider of default mortgage loan insurance, which again, we'll talk about later.
Very interesting. So, I mean, let's talk a little bit about CMH. I don't know if you're able to talk about this, but we've talked about this, or we've heard about this in the past, and most recently it's been in the news as far as what is, from your perspective, CMHC's mandate in maybe a couple sentences.
Sure. So essentially, CMHC really exists for one, reason, and that's, as Canada's National Housing Agency, it's to make housing more affordable for Canadians, for everyone in Canada. That's the number one reason that we exist. And so we do have a huge aspiration as a corporation, and that is by 2030, that everyone in Canada has a home that they can afford and it meets their needs. So that's our mandate. That's what we do. And that's essentially the number one reason for our existence.
That's awesome. So to dig into a little bit of a backstory on CMHC, like we talk to clients all day that are borrowing money. We deal with a lot of first-time buyers, second-time buyers that are actually purchasing with less than 20% down. So their mortgages are insured. Obviously, when people see the dollar amount that comes along with an insurance premium, not really a positive conversation for the most part. People are wondering why they have to pay that, right? Which we do a good job at explaining. But I think one part that a lot of clients don't really capture, that is the message that we try to put out there, is that, potentially without a CMHC or the other mortgage insurers, you might not be able to buy a property with 5% down, right? You might have to come up with 20% down. And what does that look like? It's just not an option for a lot of people, especially in the lower mainland, right? So maybe you can kind of help us understand where CMHC came from, why it was founded. Like, were you guys working with the banks and the banks needed help because the banks didn't want to do the financing with 5% down?
Sure. So, okay. So fun fact, we actually started in 1946 as a government-owned corporation to actually help address the post-war housing shortage in Canada. So we were actually formed to help house the Canadian soldiers who were coming home from World War II and didn't have access to mortgage financing. Starting a family and getting into a home was super difficult. And so that's actually where CMHC started. Since then, we became the premier provider of default mortgage loan insurance in Canada. I should mention there are two other insurers, the private insurers, of course, Canada Guarantee and Genworth. And we all have, different mandates and different shareholders. Our shareholders are, of course, Canadian taxpayers. And so CMHC was formed there, but has since then become Canada's National Housing Agency. So we're essentially involved in everything housing related across the country. That doesn't just include home ownership, obviously, that includes a number of other things in terms of affordable home ownership. But because of our mandate being to help make housing more affordable for all Canadians, that's sort of where allowing people to still be able to get into home ownership with 5% down comes from, right? And so I guess we should start with, and you guys probably talk to your clients about this all the time, but the difference in high ratio versus conventional, because those are obviously mortgage industry terms that get thrown around by us, but a lot of the time consumers have no clue what that means, and we just assume they do.
For sure. Yeah, eyes go rolling if we have that conversation, for sure. So yeah, let's break that down.
Yeah. So whenever, as a consumer, you hear the term conventional mortgage being used, we're referring to a borrower having 20% down or more. So that would make you a conventional borrower. If you're going into a high ratio purchase or you're a high ratio borrower, that means you have less than a 20% down payment. So there's a big difference there because that determines whether or not you're going to pay for mortgage loan insurance through one of the insurers. And so I guess, when we talk about what mortgage loan insurance is, a lot of the time, again, consumers think insurance, okay, and the automatic assumption is insurance protects me, the borrower, because most types of insurance do. So when we're talking about different types of insurance, there's disability, critical illness, loss of employment, life insurance, all those types of insurance which protect the borrower if anything happens to them and they can't pay their mortgage, right? So mortgage loan insurance is a little bit different in the sense that it doesn't actually protect the borrower. It protects the bank or the financial institution or the lender against any potential payment default by the borrower. So essentially, if you as the borrower can't pay your mortgage, and you're going to say, you know what, can't make my payments due to whatever financial hardship you're going through, the bank will then be protected by mortgage loan insurance and by the insurer, in this case, CMHC, for example, so that the bank can walk away without any losses. And we protect the borrower in the case of that risk of payment default by the borrower. So we're not actually protecting the borrower. Again, we're here to protect the lender, the bank, or the financial institution lending the money to the borrower. Now, should I pause there? Is there anything you guys want to add, or?
Well, just to hop in there, I mean, I want to reiterate that to the people who are listening to the episode, and as just a quick little summary of your points. So more or less, CMHC's mandate is to quote unquote make the housing opportunity affordable, or at least available, maybe a better term to use, for the average homeowner. But the purpose of buying this insurance, this mortgage loan insurance, as you're referring to it, is in fact there to protect the lender in case you're defaulting, in fact, just basically not able to make your payments. That's the primary purpose, as a summary.
And the reason why that is required is because you are not coming up with the acceptable down payment for a lender to take on the mortgage on their own without insurance involved.
Yeah, so the next point that I'm going to get to here is risk, right? So essentially, as a borrower, the less you have of a down payment, the less you've invested into this purchase, the higher the risk is that you then become to the lender to lend you that money, because you've just got less invested in this purchase, which is, hundreds of thousands of dollars. So as the lender, to protect themselves from that risk, again, mortgage loan insurance does become a requirement when you don't have 20% down. But as the borrower, you're thinking, okay, well, I have to pay for this cost of mortgage loan insurance. It doesn't actually protect me, it protects the bank. So what really is the benefit to me as the borrower? So the way that you kind of have to think about this is, the higher the risk is that you are to a bank to lend you money or to finance something for you, technically, the bank has to then make up for that risk elsewhere. So they would have had to charge you higher rates or higher fees. It costs them more the higher the risk is that you become to them. So without mortgage loan insurance in place, the bank would have to make up for that risk elsewhere with additional costs or fees. With mortgage loan insurance in place, it allows the borrower to still get into home ownership with the minimum down payment of 5%. And you still get, as the borrower, access to the same competitive interest rates as a conventional borrower gets, most of the same products and programs. And again, the bank doesn't have to charge you any additional fees throughout the life of the mortgage to make up for that risk. So you're only paying that one-time mortgage loan insurance cost at the start of getting your mortgage financed. The cost can be built into the mortgage, so you're not actually having to come up with that in cash every month. It's not like an additional monthly payment. It would be included in your mortgage payment. And again, it's just that one-time cost to offset the risk for the bank. So that's the benefit. Again, you still get into home ownership with a minimum down payment, still get access to the same competitive interest rates, most of the same products and programs as a conventional borrower.
So from a consumer,
Go ahead.
From a consumer perspective, again, just kind of overviewing the 5 to 10% down, 5 to 20% down. I mean, I think we can talk about this, and you could probably speak to this as well. I mean, typically, a lot of people, when they start looking into mortgages, they don't fully understand the mechanics behind that, which you've done a very phenomenal job explaining as to what actually occurs behind the scenes. But let's just talk about total cost from a bank perspective. Quite frequently, we see lenders, and in particular, banks and other institutions, non-bank lenders, offering better interest rates as it pertains to people who are putting down 5 to 19.99%. I mean, I think just based on our conversation, we have a pretty good understanding, we do, as to what happens. But maybe in a couple sentences, explain why would that be? Why would they offer those interest rates? And then conversely, so moving on to the whole putting 20% down, why is that not the case?
Yeah, so I mean, insured mortgages are, again, basically risk-free to the bank, right? Because they are protected in the event of payment default by the borrower. So going back to my point, again, when something becomes less risk to the bank, it becomes cheaper for them to fund. And so they are able to offer often better promotional rates for the clients that are going high ratio, because they are less risk to the bank, making it cheaper for them to then fund that mortgage, so they can offer those lower rates to the buyers that are going high ratio versus conventional. So it's risk, right? Essentially, it's risk to the lender. The less risk, the cheaper it is for them.
And then you flip that around into a conventional mortgage, which is when you're achieving that 20% down payment. The insurance is gone, so there's no insurance premium paid by the consumer, the borrower, but you're actually going to typically see a bit of a higher interest rate when you do that. And I've heard this probably 1,000 times. I'm putting down a bigger down payment. Why would I get a higher interest rate, right? But like you said, it comes down to lender risk. And in that situation, there is no insurance. So the lender is taking on 100% of the risk of that loan. So because of that, they do charge a slightly higher interest rate.
That's right. And, you know, it really depends too, right, on the size of the mortgage and all of that and the interest rate being offered, because the borrower still does have to pay the mortgage loan insurance premium, which does, you know, as I mentioned, get built into the mortgage. So often there is a benefit to somebody to go high ratio, but if they do have 20% down, generally speaking, that is still probably the cheaper option, again, depending on the situation and the cost analysis there, right? One thing that I like to kind of give as an example, though, is, you know, a lot of consumers think they have to get to that 20% down because that's a lot of the time what the, you know, mortgage professional or their realtor will tell them. And that's just what we hear, right? It's better to go 20% down if you can, because it's cheaper, you don't pay the mortgage loan insurance cost, et cetera. Which, as I mentioned again, in most cases is quite true. But if you take like an example of like a $450,000 purchase price, right? If somebody was going to put down 20%, it would be $90,000, right? So 20%, if they were trying to go conventional, they would have to save up almost $100K to get in at a conventional into a conventional mortgage. Now, the same person who, you know, doesn't have $100K saved, but maybe has, you know, 15 grand in RRSPs, maybe a little bit in TFSAs, for them to just try and save up 5% on that same $450,000 purchase price, their down payment is $22,500. So often when I talk to consumers or I go to a first-time home buyer seminar and present, I like to just show them those numbers, because people think that home ownership is completely unattainable because they have to hit that 20% down. But it's not. If you're closer to the 5% range and that's, you know, what's feasible for you and it makes sense, and you talk to your mortgage professional and, you know, financially it works for you, 5% down could make you that much closer to homeownership, right? So sometimes when you just look at those numbers, it's not to say it's better to go conventional, it's better to go high ratio. It's just to, again, paint the picture in numbers, the difference in savings when you have to try and save up 100K versus, you know, 22,500. What's more achievable for you in a shorter period of time?
Yeah, great example. And if you tie a timeline into that, right? If someone has their $25,000 currently, they could buy a property today. But maybe they have to wait for 4 years to save up their $100,000. And what have they lost out on, right? A lot of principal pay down, appreciation. So if that's a situation where you just simply don't have the 20%, for sure, 100%, it makes sense to just utilize the insurance and get into the market as soon as you can.
It's a really interesting point and a really interesting conversation, because I think quite frequently what happens, especially in the Vancouver and Fraser Valley and BC, you know, markets where we've seen so much in the way of price increases over the course of the last, you know, 7 to 10 years. I think people are looking at it as the things that have been taken away as opposed to what we have right now. And it's a really good explanation that you shared, is like, hey, we actually do have the opportunity to, you know, put down that 5%. And I think a lot of people forget that, you know, as a second-time homeowner, you could put down 5%, right? It doesn't have to be first time. There's some other programs that maybe you could touch on a little bit here. And so just that one understanding of just getting in, sometimes getting into the market and whatnot. You know, a question I have for you, and again, Bernadette, if you can't answer this question, this is okay. But just to understand, you know, one of the mandates, obviously you mentioned, is to get I think clear mandate is to be every Canadian to become a homeowner by 2030. Has there been any conversation, maybe I don't know right now with what's going on in the world, but previously about providing a little bit more flexibility to those under 20% homeowners who live in markets like we do right now? You know, they took away the 30-year amortization. We've added in a number of different stress tests and things of that nature. Is that a conversation or a topic that does come up in your understanding, or at least that you know of?
Yeah, so by 2030, it's everyone in Canada has a home that they can afford,
Ah,
and that meets their needs. So that as I mentioned earlier, that goes beyond just the scope of home ownership. Then, right?
okay.
So
Right.
we're not just talking home ownership. I just have to clarify that because that's a big piece
That is
of
big.
kind of
That is
what
a
we're
big
talking about
distinction.
right now.
Thanks
Yeah,
for clarifying that.
yeah,
So let me restate that then, because one of the things that I know is that I don't know the stats around this. Maybe you can help us, but a vast majority of
sure.
people who rent properties are renting from single tenant landlords, generally speaking, mom and
Hmm.
pop landlords, right, who have a few different
Yep.
properties. We've noticed over the last few years that CMHC has reduced the qualification or increased the qualification criteria for people looking to buy properties from the 30-year amortization down to 25, most recently down to stress test to eliminating rental properties and refinances. And in our market, we've noticed that that's obviously it made it more difficult in many cases for the incoming first-time buyer. And we've seen some attempts at first-time buyer programs. Are there any conversations that you can share with us, or is this even a conversation that CMHC even has internally that they're willing to talk about how they intend on providing more flexibility for those buyers to get into the market?
So, yeah, I mean, again, like that conversation is always open. And if you guys watch, our CEO is very vocal. He's been in the media a lot. He's done a ton of webinars, especially during COVID, with MPC. He's constantly in talks with, people like Paul Taylor and other industry professionals to, have that open conversation about what we can do to help with home ownership. But again, going back to what our 2030 aspiration is, home ownership is a piece of what we do, but as Canada's National Housing Agency, there's a number of other things that we're tackling. And our focus has shifted to creating more supply, again, beyond just the scope of market housing and home ownership. So we're talking, about like our national housing strategy, which is a 10-year plan where $55 billion is being pumped in towards housing across the country in a variety of different initiatives, a variety of different programs that CMHC is all facilitating and working with industry partners, developers, multi-unit family housing providers to create more supply, because that I think has been talked about as being one of the biggest challenges in Canada, but especially in BC, is our lack of supply, right? So when we're talking about like the qualification requirements and things like that, that's to ensure affordability for Canadians, right? Because if you look at things like debt consumption and household debt reports and things like that, there's a big concern on consumer debt levels going up, right? And so in turn, we want to ensure that people can still afford their shelter costs and their mortgage payments with the amount of consumer debt levels rising. So it's a tough balancing act, I think, but we're always open to having that conversation with mortgage professionals, and we have. There's been a lot of consultation in terms of all the things that we have made changes to, but as it stands, our changes, we made some recent changes that took place a couple of months ago, and at this point, though, that's where we're at with that. And I think, that those changes were also made in response to the pandemic, right? At any time, if we decide that we want to maybe open up flexibility again because things have changed in the market, in the industry, in people's incomes, in the employment and job security for Canadians, then we're again open to having that conversation. But as it stands right now, the changes we made are the changes we made. So.
Yeah, I think I don't want to open up too much of a can of worms. We're already going there at this point right now, but
For sure,
to
yeah.
your point about having that flexibility and whatnot, I think one of the challenges that people have a hard time comprehending is that there's no real, and again, I'll kind of end my comments on this, but there's such limited regulation around, let's say, vehicle loans and credit cards and things of that nature, but it's such a high regulation around an appreciating asset. And again, I think that's just more of a conversational tone than that. And it has less to do with
Absolutely.
CMHC, but
Yeah, and it's tough because we hear that all the time, is like we need more restriction on consumer debt, right? And restricting people to increasing credit card limits and getting vehicle loans and things like that. But essentially, consumer debt and consumer consumption is what drives the economy as well, right? So it again becomes a tough balancing act for our industry when it comes to all of that.
Yeah, fair enough. Well, just to kind of end that piece, but I did want to touch on something that you referenced about CMHC putting a ton of money back into our country, right? So to tie that all together for people, if someone pays a $20,000 CMHC premium, there's millions of Canadians that are paying these premiums. And where does the money go? Thankfully, CMHC is a federal government, it's a crown corporation, right? Now, correct me if I'm wrong, I think our default rates are at 0.35%. Is that kind of in range?
Yeah, actually, I had the arrears rate here for you guys. Yeah, we're so I only have the insured arrears rates updated. It's about 0.33 in BC.
Wow.
So I mean, that said, there's millions of people across Canada that are paying CMHC insurance premiums where there's probably not a ton of active default, right? Or CMHC to actually step in and take over those loans. So it's obviously a very profitable, from that sense, revenue-wise, corporation, right? But it's good to hear that the money is being injected back into housing.
Yeah, absolutely. Through a number of different ways, and even, not just in housing, but with any sort of government shortfall to help taxpayers. Essentially, those are our shareholders as Canadian taxpayers, right? So that money, yeah, of course, mortgage loan insurance is not for profit. It's a very profitable area of our business, and it does get put back towards Canadians and towards Canadian housing. So thanks for that point.
Yeah, I think a lot of people, again, I know we can only go so deep on this call here today, but a lot of questions that we get, on the higher level, typically are around qualification, which you've addressed earlier, and it's just an open conversation. If someone, if we had some clients that wanted to know a little bit more about how to start making a change and how to get their voice heard, just as a quick note, is there somewhere that they should continue or consider looking?
Are you talking about in terms of our guidelines, changing our guidelines?
Yeah, absolutely.
Yeah, we have definitely resources and contact information listed on our website, which is just cmhc.ca. So you can find a ton of information on there. Yeah, absolutely. And of course, talk to your mortgage professional. And we have that connection with you guys where we can always provide your feedback to underwriting, to our managers, to our directors, et cetera, right? So there's a lot of platforms for our industry where we can use that as a connection, and your clients can certainly voice their concerns. I would say they should voice their concerns to their mortgage professional first and foremost. Yeah,
it makes a lot of sense, and I think we'll definitely direct them to the right places as far as we're concerned. It's nice to work in partnership with that piece. Hey, I know Derek is probably about to hop on this, and I know he'll expand on this piece. CMHC offers a lot of programs that people don't tend to know about, and maybe are not talked about enough. Could you share with me maybe one or two programs that are probably from your perspective, the most underutilized programs that people should know about?
Absolutely, yeah. So basically, you can think of it as if you're a borrower going into a high ratio purchase, you don't have 20% down, whatever scenario you might be in, whether you are self-employed, whether you are buying a brand new home, whether you are buying an existing home that needs a bit of work, whether you're new to the country, whether you're new to credit, we pretty much have a program for everybody. So every mortgage professional should be able to talk to our programs, if I'm their rep especially. But in the event that the consumer doesn't know, or if you're a mortgage professional and you're not aware, there's two programs that I would say are always worth mentioning. The first one is Purchase Plus Improvements. So for any client that is buying an existing home, even if they're buying a brand new home, they could use Purchase Plus Improvements with it. And everybody watches a little bit of HGTV here and there, so I'm sure you're all familiar with renovating and making your home look brand spanking new again. So you can build the cost of any renovations, home upgrades, or home improvements, as we call them, into the mortgage or into the purchase price at the time of getting mortgage financing. So you're saving yourself as a borrower a ton of time and money if you qualify, because you can get those renovations done way sooner. And you're building everything into one monthly payment at a much lower mortgage interest rate than later trying to put it on, a credit card or getting a loan or a line of credit for it down the road, or even trying to save up for it, right? So even if your renovations are only going to cost you 5 or 10K, you want to just change your carpeted floors to hardwood. You want to put some paint on the walls. Basically anything structural that is going to increase the value of your home and stay with your home, you can build into the mortgage with purchase plus improvements. So that's a great one. And like I said, even with brand new condos, we've seen some people. So if you go into a pre-sale, you know how they have like different packages, and you can choose like the most basic package with just, I don't know the technical constructional renovation terms, but just basic package A, okay? And then you can upgrade to like basic package B with maybe nicer paint or the gray floors or whatever. So we've actually seen some borrowers choose, the very basic package A, which is cheaper, and then use purchase plus improvements to customize what they want their condo to look like. And it actually, a lot of the time, could end up being cheaper. Plus, you've got now your own customized home. It's not going to look like all the other units. So we have seen borrowers do that even with brand new developments.
Do you have any tips and tricks around how they come up with the funds in between the time that they complete the work and closing or afterwards?
Yeah. So, as the mortgage professional, whether you're going to a lender or a broker, you guys have access to all different products that you can cross-sell them in the meantime, right? So there are, obviously putting it on a credit card or a line of credit. At the end of the day, if you're going into a home ownership purchase, it's always a good idea to get yourself approved for an additional line of credit just for any emergencies or, special assessment or something that might come along down the road. So I would say, any of those types of things, but just as kind of a tip and trick, if you're doing the renovations on your own, Home Depot does offer a no interest credit card for, I think, the first 90 days or something like that. Don't quote me on it.
That's a good tip.
I don't work for Home Depot, but yeah, you could, there's, a ton of different financing options if you're doing the work yourself as well. There's also a lot of developers that if they know there is an approval in place for the funds, they may be able to do a portion of the work or do some of the work at a cheaper cost, at a portion of the cost versus the whole thing right away. So there's different options for sure.
Awesome. I like it.
That's a program that we do talk about quite a bit. So thanks for highlighting that. And it's interesting to hear that even CMHC brings up quite a bit from that point. Yeah.
The second program, sorry, if you don't mind.
On
that topic. Yeah, just because it kind of ties in with that one is our Green Home program. So the Green Home program, there's two parts to it. If you're buying a brand new development that is a certified green home or energy efficient building, which most of these new developments that are going up in the Lower Mainland, especially in BC, are being built to that standard, you're actually eligible for a 15 to 25% premium refund. So that mortgage loan insurance cost that we talked about that the borrower has to pay, they would actually get a portion of that, somewhere between 15 to 25% refunded back to them if it is a certified green home. The certification is by Leads Canada. So we have some information about our green home program. I won't get into all the nitty-gritty details, but it's a certification that the developer should have, the realtor should have it. As a rule of thumb, I would say check anything built in the last 5 years, because that's kind of our guideline is the certification can't be older than 5 years old. So even if it's not brand new and somebody else lived in it before and got the premium refund, the next person, if it's still a certified green home within 5 years, they're still eligible for that refund as well. So that's if they're buying brand new. If they're buying an existing home and renovating it, whether it's through purchase plus improvements or not, maybe they have the funds already. If they're making the home more energy efficient and actually improving the energy efficiency level through like EnerGuide Canada, the EnerGuide rating, they are eligible for the refund as well. So we see that out in the valley quite a bit because most of the time you can only do like really energy efficient renovations to a single detached property, which then the property, if it's going to be high ratio insured, has to be below $1 million, right? So I saw it recently for a home in Maple Ridge where the clients are doing a solar panel roof. So they were able to buy a house in Maple Ridge for I think like $800K. it was a high ratio purchase. They're going to pay a pretty hefty premium on that, but they will get a refund because they're doing a solar panel roof. They got the energy scale rating done before and after, and it did increase the energy efficiency level to a level where it met our program requirements. So they'll get a pretty good refund back on that.
That's significant. I mean, 15 to 25% of a CMHC insurance premium is thousands of dollars in some cases, right? So I feel like you guys need to put this on a commercial or something on TV so people find out about it. Because, I mean, do you guys have many applications coming through for these programs? Like, I feel like a lot of people probably wouldn't even know, right?
I think we do. Yeah. I mean, I think the applications are less in BC only because for a long time, you know, it was difficult for people who were going high ratio to find an energy efficient building that was below $1 million, or they were going conventional. They weren't doing high ratio.
Right.
But because, you know, a lot of these developments have now started offering less than a 20% deposit, they are opening up the doors to high ratio clients and more first time home buyers. We are seeing more interest in the program for sure, and more professionals, I think, are talking about it, which is great. So yeah, spread the word to any of your clients. And yeah, again, if the mortgage is already funded, you actually have 2 years to apply for the refund. So if you've forgotten about any of your clients, or if you're a consumer and your mortgage professional never told you about it, if it's within 2 years of you having funded that mortgage, you could potentially still be eligible. So yeah.
That's awesome. Thank you. So just the last thing I wanted to touch on, just to tie everything together with CMHC, mortgage brokers, lenders. So, you know, you brought up a couple of really cool programs. Just so everyone knows, when you're going through a mortgage application, we don't go direct to CMHC and try to get your mortgage approved, right? We have to find a lender that's going to be competitive on rate and product, and they have to actually offer that product that CMHC offers to make sure that it's all going to tie together, right? Because not all lenders offer every single program that CMHC is going to offer. So that's where we come in handy in being able to stick handle that and find the right solution for your financing. So from an application perspective, you would actually do an application with us or your mortgage broker or your lender. We would bring it to that institution to get them on board, and then they actually have to bring the file to CMHC for insurance approval. If the insurance comes back, if CMHC says, no, we're not comfortable with this application, the bank actually cannot approve the mortgage, right? Just to kind of tie everything together and how it works between CMHC and lending.
That's right. Yeah. So we're kind of the final stamp of approval. And I guess, you know, for the most part, I want to say, you know, generally speaking, most of our policies, we are pretty in line with lenders, but of course there are some slight differences, and there are times when we might be more flexible or the lender might be more flexible. At the end of the day, the lender, you know, their policy for the most part does supersede ours. So they need to be on board with it before they even send it to CMHC.
That's good to know. Awesome. Well, thanks so much, Bernadette, for joining us today through all the fun little technical difficulties that we had. We made it. We did it.
No problem. We did it.
Awesome. So, no, we appreciate this, and we hope anybody who's listening to this this episode was able to gather a few little tidbits and facts as it pertains to, you know, understanding about CMHC. Are they able to reach out to you directly, or do they have to contact CMHC directly if they have more questions?
So I would say if you're a consumer or a borrower, it's always best to start by talking to your mortgage professional. You guys are the advice givers. You're the education and the knowledge for your clients, right? So start with you know, your broker or your lender. Talk to you guys first. There is a consumer line if they do have questions directly for CMHC, but generally speaking, you guys are the pros and should have all the answers for them. So I would go directly to your mortgage professional first.
All right. Talk to the pros. Thank you again, Bernadette. We really appreciate you. Have a incredible rest of your day, and we'll talk to you soon.